Hello, everyone. And if you're a little anxious, a little afraid of the stock market crashing, this video is for you. There's tons of content, there's tons of news, and it's misleading. And we're going to take a deep dive into good content from good content creators. And we're going to look at some charts and we're going to show you what you need to look at that will indicate if the market is ready to crash. There will be sell-offs, but will interest rates run away? We'll find out. Let's take a look at what that is. Tom is a YouTuber. He's a really smart guy. He's gaining a lot of traction. So let's take a look at what he has to say about the importance of interest rates.
Obviously, the Fed doesn't have a dial which they spin, right? More interest, less interest. And that's exactly what the Fed has been doing for the past few months. They're buying up a lot of bonds to keep money in the stock market, to keep feeding the system with cash, with liquidity. When you're buying bonds, and I've explained this before, the Fed creates demand for a bond, which lowers the actual yield. Now, the yield lowers and everybody chases the yield elsewhere. And elsewhere is the stock market pushing the stock market upwards. Now,
so here's a macro perspective of what Tom NASH, the YouTuber here, was talking about. The more that the Fed buys in bonds, they suppress the rates and the stock market goes higher. Obviously, on the short and intermediate term, that's not true. But on a macro, long term, I'm talking decades, you can see that yes, the lower the rates and the longer they're kept low, the higher the stock market is going. You can see since 2008, the market has only gone up. And this is what he's talking about here, and this is what the Fed has been doing. So now you can actually see a representation of, the orange line there at the bottom is the 10-year yield trending downward, and then you can see, this is a daily chart, is a monthly chart, of the S&P, and you can see that it's going up higher and higher. Now let's dive into the 10-year yield specifically, because we want to take a look at what it's actually doing, as he's pointing out that this is obviously important. So let's just remove this, and let's take a look at the yield on a macro level. So this is a monthly chart of the U.S. 10-year Treasury yield, and you can see really from 1987, it's been on a downtrend. And if you ask me, well, where can we be? Where can interest rates be by the end of 2023? Well, if we look here in 2016, we had a low, and then we had an up move, right? We have like a bull flag pattern that was shaping up here in the ending of 2016, beginning of 2017, and we have something similar, a similar setup here. And in September, this is when we had the next leg higher, and it lasted until about the end of 2018. So this is your typical bull flag pattern. I think that you have an up, your A wave, B wave, and then a C wave, and we could potentially be testing. We can see rates at around 2% by the end of 2023, and that's okay. That's okay. I think that if we reach those levels, the stock market may correct and we'll be fine. But it's this other scenario that Tom will explain here that we may be worried about, and we'll come back to the charts to take a look at that. Okay.
imagine this situation. Imagine that now the Fed lowers the amount of assets they purchase every month. Right now, they're spending about $120 billion per month. Imagine they slash it by half. Demand goes significantly down. Yield goes up. If that happens, people will be chasing more yield in the bond market, essentially driving away demand from the stock market to the bond market, creating less demand for stocks, reducing the price. Now, that's the big fear. Now, here's the thing. If you have the situation where the Fed eases basically the foot and they don't press on the gas so much, and they're basically trying to slow down the inflation by actually increasing interest rates, what might happen is what a lot of people define as a taper tantrum.
So if you don't know what a taper tantrum is, we have the definition here for you. Taper tantrum refers to the 2013 collective reaction panic that triggered a spike in U.S. Treasury yields after investors learned that the Federal Reserve was slowly putting the brakes on its quantitative easing. Now let's flip back to the chart. Now let's take a look at 2013. Let's put our arrows back on, and we probably most likely, are referring to this moment here, so where we broke out from 1.666 to 2.98 roughly. So there was a 100% increase in yield. That seems to be the spike, and we could see something here in again. And that would actually, if we saw a 100% uptick, it would actually bring us to about 2.24, right? So that really lines up with these this upper trend. So we could see something like this by the end of 2023. Maybe we chop a bit more, it takes more time to develop, and then we spike up at some point to this area. And that's okay, and there will be panic, but again, this upper pink line here is over decades. I think it's a 30-year-old trend line. Let's scroll back. 1887. So that's 13 years plus 20, so that's 33 years. The scenario that we want to watch out for in probably mid to late 2020s is a spike through these trend lines, these 3-decade-year-old trend lines, a retest, and then a continuation. That would spell catastrophe, right? And that is only years to come. But this is where the hyperinflation, the fear is coming out, is if something like this would happen. So hopefully you learned something. Thank you for following. Please subscribe, comment below, tell me what you think, if this was helpful. But this is where you really want to watch a 10-year yield. If it stays within or below this long-term trend line, the stock market will be fine. But if we break out of these trend lines, I think it's going to be really scary, and we're going to see a meltdown. So that is going to be my indicator. I'm going to be watching this closely for the next decade, and that's how I will be managing my risk. I do have a Patreon, so if you want to join me there for more stock market education and entertainment, please do so. The link is in the description below.